Good morning, Gators. Thank you for joining us today for the very first Generation Broke seminar. My name is Orlando Perez, and as a student chair of today's personal finance seminar, it is my pleasure to introduce to you the Executive Director of the University of Florida Alumni Association. One of the top alumni affairs professionals in the country, she is committed to excellence and has her sights firmly set on bringing University of Florida Alumni Association to the #1 ranking in the nation. Please join me in giving a warm Gator welcome to Ms. Danita Nayas.
Good morning, Gators. Good morning. How are you? Forgive me, I've been a little sick this week, but I did not want to miss this opportunity to welcome you to this inaugural program. First, I want to thank Orlando Perez and one of my favorite student groups, the Cicerones. The Cicerones work closely with your Alumni Association to determine how to help you by providing programs like we're providing today. So here's the situation. The Cicerones work with Rachel Johnson, and they have been sharing with her throughout the year the effect of the economy and what it's been like for young people. And so we put our minds together and conceived of this program. And so our whole goal today is to help prepare you for what it's going to be like when you graduate and how to make very smart decisions with your finances so that in 5-10 years you can come back as a great Gator and help students who will be sitting in your spot 10 years from now. So we thank you for coming on a Saturday morning and learning and growing. And if you have any questions, you've got Cicerones here that you can ask. Rachel's here. You're going to meet some wonderful people who have great expertise in the area of financial management. And I only wish that I had the opportunity to do this 30 years ago. So thanks for coming. Enjoy, learn as much as you can, and put into practice what you learned today. All right? Go Gators.
Now, as you set up yourself for a successful financial future, you'll see that your local bank can help with many of your financial needs. Services include general bank accounts, consumer and residential loans, certificates of deposits, and commercial and business banking. Our presenters this morning will help you understand some of the resources provided by your local bank. Heather Gray is a store manager in the North Central Florida market for TD Bank. Mrs. Gray earned her undergraduate degree from the University of Florida and began her career in banking over 15 years ago as a consumer loan officer. She has spent the last 10 years successfully leading her team at TD Bank. Her colleague, Susan Griffin, is also a store manager in the North Central Florida market. She began her career in banking over 20 years ago. Ms. Griffin is involved with many community activities, including United Way, Junior Achievement, the Marion County Chamber of Commerce, and the Marion County Humane Society. Now, please join me in giving a warm welcome to Susan Griffin and Heather Gray.
Good morning, everybody. Thank you so much for coming today. From one Gator to another, to start things off, can I have "It's great to be a Florida Gator"? Come on, guys, one more time. Be a Florida Gator. There you go. Thank you so much for your participation. I do have a list of everyone who is here today, so I'm going to start things off. I don't know anyone in the room, so I'm just randomly picking a name. It's Marissa Miller here. Thank you. I'm not picking on you to ask you any questions. I just want to thank you for coming today. Just a little package from TD Bank. Thanks for being here. I'm going to walk around. I'm a little enthusiastic, so I may not be up in the front of the room speaking to you. Feel free. We're going to have a question and answers at the very end after Susan speaks. So I'm going to begin the presentation. As I mentioned, from one Gator to another, we're going to talk through today understanding what a credit score is and why it's important, explain how credit scores are calculated and what affect them, Where to obtain an annual credit report for free. The most common and easy ways to start building your credit history and keeping your credit in good standing. Let's begin. I'm going to talk to you about credit scores, but let me first tell you what credit is. Credit is the money you borrow to pay for things. It's usually referred to as a loan. You make a promise to pay back the money you borrowed plus some extra. The extra amount is part of the cost of borrowing the money. If you use credit carefully, it can be useful. If you're not careful, it can cause problems. And we'll go into some of those today. Why is credit important? It can be useful in times of emergency. It is sometimes more convenient than cash, and it allows you to make large purchases. With a show of hands, does anyone know what your credit score is? What's your score? 780. Excellent, good job. Do you know what the highest score? It's actually 850 now. Good job, that's excellent for knowing that. Here you go. How many people have multiple credit cards? Do you know what your interest rates are on those? Okay, very good. We're going to go through today what interest rate the percentages are. Were you ever late or defaulting on a payment? I'm going to talk to you how that might affect your credit in the future. Credit scores and its importance. Credit score is a numerical expression of a person's credit worthiness, usually between 300 and 850. So congratulations, your credit score is excellent. Also known as a FICO score. It is used by lenders to predict the likelihood that a borrower will repay his or her debt before approving the loan request. Credit influences your daily life in many ways, such as a car insurance, student loan, renting an apartment, or applying for jobs. The higher the number, the more likely you will reach your financial goals. This will make more sense when Susan talks to you about getting prepared for major purchases like your first home. Just another quick snapshot. Credit scores provide your credit risk level at a given point in time. 750 and up, fantastic. That has the ability to save you 4% interest than other borrowers with lower scores. 680, great borrower. 680 and below, you will pay a higher rate of interest for your loans. And a 550 and below, not very good, difficult to obtain a loan. In lending, banks look for 3 factors to decide whether you're good credit risk and whether you'll be able to pay the loan. We refer to this as the 3 C's of credit. The capacity, do you have the income to make the payments? The capital, do you have the savings or other assets you can use as collateral? And character, how have you paid your bills in the past? You have a whole page of notes, so I'm not going to go through this, but when applying for credit, certain questions that might be asked of you, and Susan will touch on a couple of these. How long have you been on your job? How much money do you make each month? How much do you have in your checking and in your savings account? And have you ever had late payments? Tips before applying for credit. Ask yourself these questions before obtaining credit. Do I need this? Do I need it now? Can I wait to have cash to pay for it? Are there any fees? And what's the annual percentage rate? If possible, pay your bill off every month. If you can't, try to pay more than the minimum balance. Pay on time to avoid late fees and to protect your credit. If you can't, call your creditor immediately to explain the situation. Always, always check your monthly statements to verify the transactions that are on there. Ignore offers creditors may send you to reduce or skip payments. You will still be charged for the finance charges during this period. And think about the cost difference if you purchase your item with cash versus if you purchase it with credit. The 5 factors that determine your credit score. Payment history, 35%. The amount you owe. The length of your credit history. how much new credit you have, and credit mix. The next slide is very important, and it's all in your attachments that you have, but getting an annual credit report for free. For those who don't know what your credit score is or don't know what is in your credit, if you go to www.annualcreditreport.com, you can request a copy of your credit report for free one time in a 12-month period. Who grants credit? Lenders, TD Bank, credit unions, finance companies, credit card companies, captive financing, and private individuals. The next slide is ways to start building your credit. 3 different types of credit cards, for example, to help establish your credit. TD offers 3 different types. The first one's a standard credit card, the most common type of credit with a revolving balance. It's best for people with good financial management skills and a decent credit history. Prepaid credit cards. This is a way to establish your credit, and it shows good credit behavior. Users must deposit the money onto the card before you can use it, and it helps new users build credit history like a standard credit card. And finally, a reward program. Reward programs are an add-on benefits for cardholders. The most common are cashback, reward points, and travel points. The next slide really shows a need versus want. Think about this when you're in the working world. The pros are it's convenient in your time of needs, but it makes buying easy and can result in overspending. It helps you build a solid credit history, but it's reckless you can use to have more debt. Be sure to read the fine print on any special offers presented when shopping around for different credit cards. Do pay your bills on time. Do keep your balances low. Contact your creditor if you're having trouble. Don't open new credit cards that you don't need. Interest rates. Most cards offer a low introductory interest rate for a limited time, but it can reach as high as 29%. I know you mentioned you have a 0% and 10%. Credit cards can go as high as 29% when the promotion ends. If you have good credit, call and try to negotiate, which normally credit card companies do, up to 4% to lower that based on a good credit score. Late fees. You don't want this. It will affect your credit score. Late fees should not be in your vocabulary, but I'm still going to tell you what it is. It's the penalty for not paying for your balances. Therefore, the due date range per cycle is $20 to $30. Other sources of credit besides credit cards. We have unsecured loans, personal secured loans, such as loans secured by a savings account, money market, or your car, home equity loans, and mortgages, which Susan will cover in more detail. To wrap up, these are ways, hold on, y'all. Okay. To wrap up, these are good ways to keep your credit in good standing. This is key for your credit score and ongoing credit worthiness. Let's review. Keep your credit in good standing. Budget, live within your means. So often we get in trouble when we use credit but don't have a plan for repaying the credit. Carrying large balances on credit cards can mean that we only pay the interest each month, never touching what's owed, the principal amount. This is a trap we all need to avoid. Throughout your life, there will be many times when you may not have enough cash for purchases or emergencies, and having good credit will help you when you need to borrow. Remember these tips, and you'll be on the right road to success. Go Gators.
Good morning, everybody. Everybody ready? I'm here to talk to you a little bit about living the American dream to home ownership. So the steps to purchasing. We're going to go through the bird's eye view very quickly, and then I'm going to go into a little bit more depth. Get this to work. The process of buying a home is very exciting, but can be very complicated. You must understand certain things with regard to purchasing the home. There's lots of different programs that are available, which I'm going to go into a little bit further. And once you do all of those things, you'll be a new homeowner. There's 6 steps with pros and cons. The first thing is you've got to decide, is this the right choice for you? You know, if you're renting versus having a mortgage, there are benefits to having a mortgage, like tax deductions, but there's a con in the fact that you have to do the repairs and the maintenance on that home. You may lose, you're going to gain the freedom of investing into your home and building equity in that home, but you may lose some of the freedom in the fact that you're going to have to mow the grass and do all those things. So you've got to decide if home ownership is what you're looking for. The second step is taking a home buyer education course. This allows you to qualify for several different programs that are out there for first-time home buyers, which I'll go into a little bit further later. Then the next step would be to get pre-qualified by TD Bank. Then you might want to find a realtor. Once we go through all this, like I said, this is just a quick overview. And finding a home, getting your mortgage, and then closing. What the lender looks at is they want to see if you can afford the home. Basically, if you have decent credit, steady income, basically saying that you can afford 2.5 to 3 times of your yearly income. For example, if you have yearly income of $60,000, you can afford a home that's $180,000. Lenders look at 4 things. Credit, which, thank you, Heather, for going over that. Cash, your capacity to buy the capacity to repay the loan, and the collateral. And I'm going to go over that a little bit further later. With regard to your credit, there are certain guidelines, things that we look for. We're looking that you've paid your debts that you presently have on time, and your prior debts. We are looking at, are you renting? How long have you rented? And did you pay that rent on time? You must have a credit score, which she went over. And if you don't, there are alternative ways for you to build that credit. Things that we don't like to see are delinquencies, charge-offs, judgments, because if you have those, problems will occur, and you'll have to clean those up before you can purchase. The other important part of purchasing a home is you do have to have cash. There is a down payment requirement. There's different programs. The down payments range from 3.5% or all the way up to 20%, depending upon the type of loan program. We look to see if you have in savings, in your savings account or in your checking account. If you don't, you can get that money by means of a gift from a relative. On the capacity piece, we do look to see, that you have a employment history in the same line of work. I'm going to go into a little bit more depth on that. And that if you have any other sources of income, here's list Social Security and disability. I don't think any of you fall into that category. However, you do have to verify that as well. And finally, the collateral. We do want to make sure that the house is worth what you're paying for it, so it is appraised, and then we go from there. The second step with the home buyer class, this is really important if you do want to qualify for a home buyer's assistance program or whatever. This class teaches you pretty much the process of purchasing a home by going through all the steps, including, finding that right agent or finding that home that's going to fit your needs, how to make the offer, what kind of mortgage is going to best suit your needs, and then the inspection of the property and the process of the closing. Then the next step, of course, is getting pre-qualified, which TD Bank is wonderful at doing that for all of y'all if you're ready at that point. Then you start your house hunting. Basically, that pre-qualification letter gives you kind of a ticket to say, I'm ready to go look for a house. And you can work with the realtor, and then they will assist you in writing that contract. And from that point, then you're ready to make your mortgage application. And you come in and you bring in your proof of income and all of your documentations, and you go through that process. Then a loan decision is made, and with TD Bank, we have a wonderful process that you get that within 24 hours of the time that you submit that application, whether you're approved or denied. Approved with conditions or denied, and you are given reasons on that, and I'm going to touch on that a little later. Types of mortgages that are available: you have fixed rate, you have an adjustable rate, and then you have your government products, which are FHA and VA. Now, VA, you do need to be either in the military or have been in the military to qualify for that loan. We have the affordable loans, and then loans that do have down payment assistance available. And that's where the home buyer education class comes in. If you don't take that class, you don't qualify for those loans. Then, of course, step 6, you go to the closing after you've been through this whole process, and that's where the seller and the buyer come together to make sure that you've, of course, met all the provisions of the contract, and then the ownership of that home is transferred to you, which that is the best day of all after the whole process. The next steps, this slide is kind of out of order. This is if you were to be denied. I would say that then at that point you could meet with a bank representative, your loan originator, to discuss strategies of trying to get you to that point of being able to purchase a home by either saving some more money if you didn't have enough funds to close, or reducing your debt if your debt to income ratio was not within the guidelines. And if you had some credit issues, it's possible to, work with a credit counselor. Now, this part is where I'm going to get into a little bit more on the preparation of purchasing a home. We look at employment, income sources, credit, down payment, and your funds to close. With regard to employment, 2 years of employment is required prior to application. You can have recent job changes, however, it must be in the same line of work. If there's any gaps that are over 1 month, they're going to ask you to explain them in writing. If you have less than 2 years of employment, that is satisfactory if in the instance of you just recently graduated or you have served in the military. Income sources. This may not apply because I doubt any of you are retired. Some of you might receive disability income, or you may have a trust and you receive income. If you do get any of these sources, you do have to verify them with a form of documentation that it's going to continue for at least 3 years. Credit. Heather did a fantastic job of explaining credit because it is very, very important. We look at your credit to determine whether or not you're capable of repaying the loan. We look at your credit cards, your personal loans, your auto loans, any type of thing that you have on your credit, and that is how we come up with whether or not you qualify for the loan, which is known as your debt to income ratio. We look very detailed at, have you had any late payments within the last 12 months? Because if you had, you're going to have to explain them as to why did they happen. Anybody have any questions on that? No? If you have any delinquent accounts on your credit, they're going to ask you to write a written explanation as to why it occurred. And in a lot of instances, it's going to have to be paid prior to closing. There are certain loan programs that do allow you to have like a medical collection or something like that, but most of them do require that they be paid. Judgments and garnishments and liens, this is not a good thing to see, but if you do have those on your credit, you have to have made payment arrangements and been making those payments for at least 3 months, or that's going to have to be taken care of prior to closing. Because a judgment or lien falls into a first place lien on your home, meaning if you were to go buy a home, that's going to be in first place as opposed to us, the lender. We need to be that first lien holder on that. So they're going to either say, we've got to have it paid, or you have to have been under some kind of payment history with documentation. Bankruptcy, if you have filed bankruptcy, you can buy a home, but you have to have had at least 2 years from the date of the discharge. Credit must be reestablished, and you must do a detailed written explanation as to why you filed bankruptcy and have copies of your discharge papers. Down payment. Down payment is usually a big issue with people. How much money do I have to have? We have several different loan programs. We have the conventional loan program. Typically, minimum requirement is 5%, but in order to avoid what we call PMI, which is private mortgage insurance, you really need 20%. FHA is our government product that requires 3.5% down, which is really not a lot of money. And the beauty of that is you can also get your down payment in forms of a gift from a family member where they agree that you don't have to pay it back. Funds to close. You as the borrower are responsible for closing costs and the prepaid items, which is the costs involved in purchasing the home. However, you can get those funds from a family member in the form of a gift, or a municipality, or nonprofit organization, or church. And if the contract is written, you can have seller contributions because there are ways to get the seller to pay some of those costs for you. We as lenders are going to ask for your bank statements. We're looking for at least a 60-day, most likely a 90-day seasoning requirement on your funds needed. So we're going to ask for your bank statements. And if you have any large deposits on there, say for example, your grandma gives you $10,000 and says, they know you're looking for a house, and she says, I'm going to give you $10,000. And you put that into your bank account, and it shows as a $10,000 deposit. I'm going to ask you where did that come from, and it's going to be a gift from your grandma. So you're going to have to execute the gift documentation. Or if, say, for example, you decide you want to buy a house and you have a four-wheeler and you decide you want to sell it. So you get $5,000 for the four-wheeler and you put it into your bank account. I'm going to ask you for a bill of sale for that $5,000. So a lot of times people say, oh, I just sold it to my friend. Well, did you write a bill of sale? So those are things just to think about, when you're depositing large amounts into your account, because we are going to ask where it came from. Yes? Well, it's really not a penalty, but if you only put 5% down, you have to pay what's called private mortgage insurance, which is an additional insurance that has to be taken out on the loan because you're not putting that 20% investment in. And so, for example, on $100,000, you may have to pay an additional $45 or $50 a month in your monthly payment because of the fact that you did not put that 20% down. No, it does not change. With TD Bank, it does not change your interest rate, whether you put 5% down or you put 20% down. Our interest rate is the same. For 30 years, it's the same as if you put, the 5% versus the 20%. Now, some other lenders may hike the rate up based on that loan-to-value requirement. But with TD Bank, we do not. It's just, you really don't want to pay private mortgage insurance. Now, on the FHA piece, you're going to pay mortgage insurance for the first 60 payments, whether you put 3.5% down or you put 20% down. It's just a little different factor in what that total payment's going to be. But for first-time home buyers, I always recommend the FHA if it's going to be your primary home, because it's easier for you to come up with that 3.5% versus that 20%. Or even if you put 10% down, you're still going to be in a better situation because of the fact that there's so many other factors with that loan program. They allow your debt ratio to be higher. They allow you to have, with example, if you had filed bankruptcy, that's where the 2 years comes in. With conventional financing, you have to have 4 years from the discharge. So there's a lot of little different things that come into play depending upon your personal credit situation as to whether or not FHA is going to better suit you versus conventional. That answer your question? Well, hey, I have something for you since you... Private mortgage insurance? Right. PMI is private mortgage insurance, and it protects the investor of your loan because of the loan to value, meaning that you didn't put the 20% down. PMI is just an insurance because of the fact that we loaned you more money as opposed to the lower amount. But it is not, a lot of people do think that it is insurance in the event that they die or something like that, and it does not protect you in any way, shape, form, or fashion. It protects the investor of the loan. Oh, well, that brings me to questions. Does anybody else have any questions? Yes. Well, tenants in common is like if you and your husband were going to purchase the home together. So you would qualify on both of your credits as opposed to just yourself. And that you own that home jointly together and you're going to live there together. So it really doesn't, you have to look at each person individually. So if your lender, like in my case, our case, we have a minimum credit score of 640 that you have to have in order to qualify. If, say, you had a 680 and he had a 639, we may recommend to say, hey, let's take him off of the loan and we're going to put it in your name. But in the state of Florida, if you are married, your spouse has to sign the mortgage and the truth in lending that you are taking that loan out, even if they're not obligated on the note because of the dowry laws in the state of Florida. Not all states do require that, though. Good question. Anybody else? Yes. Of the closing costs? Well, closing costs, a good rule of thumb is if it's about 3.5% of the loan amount. But your closing costs are going to be, you have lender fees. TD Bank's lender fees, by the way, are a lot less than some of the competitors. But lender fees are actually listed as an origination, but they're actually what the lender charges to give you that loan. So everyone that touches that loan is what that fee is for. In our case, it's about $618. Then you're going to have your appraisal fee, your credit report fee, your tax service fee. And these are non-related fees that are third-party fees that we charge whatever the third-party organization charges us, and then we pass that on to you. You're also going to have title insurance. And title insurance is the title company or the attorney who is doing the closing, and they do a title search on the property to make sure that there are no liens or encroachments or anything like that on the property. Here again, the collateral is being checked to make sure that it can be transferred free and clear of any liens to you when you purchase it. So though you have those fees, and they're actually mandated by the state pretty much. There's a formula that you use. And then there's dock stamps and intangible tax in the state of Florida that you have to pay on the deed. And those are a set figure. And then you have your survey and those items. It usually comes out to be about 3.5%. Now, if you escrow for taxes and insurances, which are two things that you do have to pay and keep up on the home that you purchase, that is called your escrow account. And that it also adds to your closing costs if you escrow, which if you borrow more than 80%, you have to escrow. And on an FHA loan, it's required that you escrow for taxes and insurances. Yes, sir. Correct. That's a good question. As I mentioned earlier, that you can have seller contributions, and that is with regard to your closing costs and prepaids. On an FHA transaction, the government allows us that the seller can pay up to 6% of the cash purchase price. So what you do is you want to say, hey, will you pay my closing costs and prepaids? And if the property appraises, then he can pay up to 6%, which can basically get you into a home for your down payment, which is about 3.5%, if the numbers fall right. But of course, it could be a little bit more than that. That's a very, very good point, because and on a conventional transaction, it's 3%. So there are certain guidelines depending upon the type of loan that you have. Yes? Well, a judgment is, let's say you bought a car from somebody and then you decided that you didn't want it. And that person, they go to the courthouse and they prepare a document and they record it in the courthouse that you owe them $15,000. That can show up on your credit report as a judgment that's been recorded into the public records. A lien is, let's say you don't pay your taxes, and the IRS comes to you and says, hey, you owe me money, and you say, I don't have it, well, they're going to place a lien on your credit report. Garnishments. Garnishments could be, let's say, yeah, that's what I was going to try to, I was figuring out a way to say that. Let's say you have a baby, and the father of your baby is supposed to pay you child support, and he doesn't. Well, you can file a garnishment against him, and it's going to show on his credit that he owes you back child support. Does that answer your question? Okay. Anybody else? Yes, ma'am. Good question. Student loans, actually, if you can show that you do not have to repay them for 2 years? 2 to 3 years. That does not play a part into your debt-to-income ratio. So if you're not obligated to repay those back for that period of time, you can go to whomever granted you the loan, and then that comes out of your debt-to-income ratio. Anybody else have any questions? And I have a debt-to-income ratio. That's a good question too. Debt-to-income ratio is your gross monthly income. We use gross. A lot of people say, why don't you use net? But, because that's what you get. But we use your gross monthly income. And in our case, you have to have a debt ratio of 41%. So you take your gross monthly income, and I always times it times 41%, and that gives me the maximum amount of debt that you can have. Then I take your bills. Let's say you have an auto payment, you have a credit card, and you deduct that from that maximum amount, and that tells me what is the amount of a house payment that you can afford, including your taxes and insurances. So all of your bills and the new house payment have to be at 41% or under. Now, if you go with FHA, they do allow it to go up to about 43%. So that's why where the program plays into play as to what might best suit your needs. If you don't have any other debt, you may want to go with the conventional. You've got money to put down. If you don't, and your debt ratio, you've got some other bills, and your debt ratio is a little tight, you might want to go with the FHA. Yes? FHA loan is a first-time home buyer, Federal Home Administration loan. It's a loan that's backed by the government. And you can qualify for one if you've never had one before, because if you already have one, you can't have another. And as a first-time home buyer, a lot of times people think, I'm not a first-time home buyer because I've owned a home before. If you haven't owned a home in the last 3 years, you qualify for an FHA loan. One more question? Oh, well, okay, we'll do quick. Well, there's different programs. There's, SHIP, and actually I do have offline. I guess I could try to get a phone number for you for that, because there are different organizations that teach those classes, and I don't really have that information, but we can get that. I can get that to Rachel, and she can get that out to you. Right. So there's lots of different places. Right. One more quick question to this young lady up here, and then we'll have to wrap up. Oh, okay. And then I do have, did you give me that list? I have some other cards I didn't use. You pick a name. You don't have your glasses on? How about William Morosco?
Wonderful.
Did I get your name right?
So again, if we would please, I would like to thank Heather Gray and Susan Griffith for joining us. And don't leave yet, because as a token of our gratitude, we'd like to present them with a special gift. In the back. Yeah, one more time for our presenters for the general session. Thank you. Now, as far as where we're going to next, please review your agenda attendee binder to see the concurrent sessions and the room locations. We're going to have 5 sessions available to you today. You'll be able to choose 2 of the 5 sessions. But all the other sessions will be available online within the next week. And before we break, the Cicerones will be able to direct the attendees to specific breakout sessions, and we are having it at a 20-person per room basis. So if there's one you really want to get to, go to that immediately. And we're going to start at 11 a.m. We're going to start the first session. We'll see you back here at 12:20. Thank you.